Have you ever felt that surge of excitement when a brilliant business idea strikes, only to have it deflate into a quiet sigh when you realize you need capital to make a reality? You're not alone. The world of small business financing can feel like a labyrinth with countless paths and confusing signs. But what if there was a way to navigate this maze with greater ease, to find the right funding for your specific needs, without endlessly applying to individual lenders? That's where a platform like Lendio comes in. Today, we're going to break down the key minimum requirements that Lendio and its partner lenders typically look for. We'll delve into the vital factors like credit score, time in business, and annual revenue. But we won't stop there. We'll also touch upon other important considerations like collateral, industry, and essential documentation you'll need to have in order. By the end of this video, you'll have a much clearer picture of what it takes to leverage Lendio's platform and unlock the funding your business deserves. Let's start with the big three, the foundational pillars that almost every lender, through Lendio or otherwise, will scrutinize: credit score, time in business, and annual revenue. First up, credit score. This is often the immediate concern for many small business owners, and for good reason. Lenders use credit scores as a quick indicator of your financial responsibility. It's important to understand that when we talk about credit score in the context of small business loans, it often refers to both your personal credit score and, if applicable, your business credit score. While Lendio's network is vast and includes options for businesses with less than perfect credit, generally, a personal credit score of at least 500 to 600 is often cited as a minimum to even begin to find options. However, for more favorable rates and a wider array of choices, a score in the 600s or higher is significantly better. For instance, a business line of credit typically requires a minimum personal FICO score of 600, and for SBA loans, you're usually looking at 650 or higher. Equipment financing can sometimes go as low as 520, and merchant cash advances might be accessible with a 500-plus score. The higher your score, the more trust you build with lenders, which translates to better terms, lower interest rates, and higher loan amounts. If your personal credit score isn't where it needs to be, focus on paying bills on time, reducing debt, and checking your credit report for errors. Next, let's talk about time in business. This requirement speaks to stability and experience. Lenders want to see that your business isn't just a fleeting idea, but a legitimate entity with a track record. While some niche funding options like certain equipment financing or even some startup loans through Lendio's partners might accommodate businesses with as little as 3 to 6 months in operation, the general rule of thumb for most traditional small business loans is at least 6 months to 2 years. For more substantial loans, particularly government-backed SBA loans, lenders typically prefer to see 2 years or more in business, along with corresponding financial statements. If you're a relatively new business, don't despair. Lendio does have options designed for startups, but understanding this benchmark helps you set realistic expectations. Finally, we arrive at annual revenue. This is a direct measure of your business's financial health and its capacity to generate income. Lenders need to be confident that you have sufficient cash flow to manage loan repayments. While the specific minimum can vary significantly depending on a loan type and lender, a common baseline for many Lendio partners is an annual revenue of at least $50,000. However, some loan types and lenders will have higher thresholds. For example, some term loan partners look for a minimum annual revenue of $96,000, and for a business line of credit, it's often around $50,000 annually. For invoice factoring, which leverages your outstanding invoices, a minimum of $10,000 in monthly invoices might be required. Generally, the higher your consistent annual revenue, the more attractive you are to lenders and the greater your borrowing capacity. This isn't just about total sales. Lenders will often look at your profitability as well, ensuring that the revenue translates into a healthy bottom line. Crucially, financial documentation is paramount. Even if you meet the quantitative minimums, you need to be able to prove it. When you apply through Lendio, you'll be asked to provide various documents that offer a clear picture of your business's financial health. This typically includes business bank statements, tax returns, profit and loss, P&L, statement and balance sheet, proof of business ownership, driver's license or state ID, and a voided check, business plan, Having these documents organized and readily available will significantly streamline your application process through Lendio. The more complete and accurate your information, the faster lenders can assess your eligibility and present offers. It's also worth noting that Lendio's broad network means that the specific minimum requirements can vary considerably depending on the type of loan you're seeking. For example, term loans often require a minimum personal credit score of 600 and at least 6 months to 1 year in business, with annual revenues typically starting around $50,000 or more. Lines of credit, similar to term loans, often requiring a 600 plus credit score, 6+ months in business, and at least $50,000 in annual revenue. SBA loans. These are government-backed loans with more specific eligibility criteria set by the Small Business Administration. Generally, you'll need a personal credit score of 650 plus, at least 2 years in business, and potentially higher annual revenue requirements. Some sources indicate $96,000 plus. They also require you to be a for-profit business, operating in the U.S., and often require personal guarantees. Equipment financing can be more flexible on time in business, sometimes even for newer businesses, and personal credit score as low as 520, as equipment itself serves as collateral. Minimum annual revenue is often around $50,000. Invoice factoring. Accounts receivable financing focuses on your outstanding invoices. While often having no strict credit score requirement, it typically requires a minimum monthly or annual volume of invoices. Some lenders look for at least 3 months in business. Merchant cash advances. MCAs, these are advances against your future credit card sales. They're often the most accessible for businesses with lower credit scores, 500 plus, and can have shorter time in business requirements, as low as 6 months. However, their repayment structure can be more expensive. The beauty of Lendio is that you don't need to be an expert in all these different loan types and their individual requirements. By filling out a single application on their platform, Lendio's smart matching algorithm presents you with the options you're most likely to qualify for based on the information you provide. This eliminates the guesswork and the wasted time of applying to unsuitable lenders. Remember, funding is often a journey, and even if you don't meet all the ideal criteria today, understanding these requirements empowers you to build a stronger, more fundable business for tomorrow. With that said, thanks for watching, and until next time.